Today, it is a multi-billion-dollar cinematic empire that dominates global pop culture. It is a crown jewel in the Disney portfolio, printing money at the box office and moving billions in merchandise every single year. But in 1996, the world's most famous superhero universe was completely bankrupt. The company was bleeding cash, its stock was worthless, and the iconic characters were caught in a vicious, bloody war between two of the most ruthless billionaires on Wall Street. This is the story of how a comic book company was transformed into a toxic financial weapon, and the ultimate boardroom coup that saved it from total annihilation. Welcome to Case 013. Today, we open the file on the 1996 corporate war. We will investigate how extreme leverage, financial engineering, and absolute greed nearly destroyed an American institution, and how a plastic action figure executive outsmarted the smartest guys in the room. Our story begins in 1989, at the height of the Wall Street corporate raider era. Ronald Perelman was a billionaire financier who specialized in leveraged buyouts. He didn't build companies from the ground up. He bought struggling companies using massive amounts of high-interest debt, known as junk bonds. He would then squeeze the companies for cash, restructure them, and sell them off for a massive personal profit. Perelman looked at this particular comic book publisher and didn't see art, or mythology, or a loyal fan base. He saw an undermonetized intellectual property farm. He bought the company for $82.5 million, using just $10.5 million of his own money. The rest was financed entirely with junk debt. Almost immediately, Perelman took the company public. He used the cash from the IPO not to reward the writers and artists, but to aggressively acquire other companies. He bought trading card companies, sticker companies, and distribution networks. He was treating a creative storytelling medium like a massive, aggressive corporate conglomerate. And for a brief, blinding moment, the strategy seemed to work perfectly. To service the massive mountain of debt Perelman had placed on the company's balance sheet, revenue had to increase exponentially. And it had to happen immediately. The executives ordered a massive surge in comic book prices. But, more destructively, they began exploiting the collector's market. They realized that fans were buying multiple copies of #1 issues, hoping they would appreciate in value over time, like an investment. So, the company stopped focusing on the quality of the stories and started focusing on the packaging. They pumped out millions of comics with holographic covers, foil-stamped covers, glow-in-the-dark covers, and poly-bagged special editions. They would release 5 different variant covers for the exact same comic book, artificially forcing loyal fans to buy the same story 5 times just to complete their collection. It was a classic, manufactured financial bubble. Between 1989 and 1993, revenues exploded. The stock price skyrocketed from $2 a share to over $34 a share. Ronald Perelman was hailed as a financial genius. The market believed the comic book industry had been completely revolutionized. But there was a catastrophic flaw in the business model. The company was alienating its core customers. The stories were suffering. And, eventually, the fans realized that a comic book with a shiny foil cover isn't actually rare if the company prints 3 million copies of it. The collector's market stopped buying. They realized their investments were worthless. But, as the stock plummeted and bankruptcy loomed, a legendary billionaire swooped in, attempting to seize the entire universe for pennies on the dollar. However, both of these financial titans were about to be outsmarted by a guy who made plastic action figures. We'll look at the ultimate boardroom coup shortly. When a financial bubble bursts, the collapse is violently fast. In 1994, the comic book market cratered. Sales dropped by a staggering 70%. The company, burdened by the massive junk bond debt Perelman had used to build his empire, was suddenly suffocating. They couldn't make the interest payments. The stock price, once flying high at $34, went into a terrifying freefall, crashing down to barely $2 a share. Ronald Perelman, facing total ruin of his investment, came up with a desperate restructuring plan. He proposed issuing millions of new shares of stock to buy out a company called Toy Biz. Toy Biz was the manufacturer that held the exclusive, highly lucrative license to make action figures based on the comic book characters. Perelman's plan was to merge the two companies and retain absolute control, but issuing that much new stock would completely dilute the value of the shares held by the existing bondholders. The bondholders, who had lent Perelman the money in the first place, realized they were about to be left with absolutely nothing. They needed a savior. They needed a corporate predator to fight Ronald Perelman. Enter Carl Icahn. Carl Icahn was and still is one of the most feared activist investors in Wall Street history. He smelled blood in the water. Icahn saw that the comic book company's bonds were trading at literal pennies on the dollar because everyone assumed they would default. Icahn quietly and aggressively began buying up the junk bonds. By 1996, he had purchased enough debt to control 25% of the company's bonds. He effectively owned the company's mortgage. Carl Icahn didn't care about the comic book business any more than Perelman did. He cared about winning the financial war. When Perelman announced his restructuring plan, Icahn blocked it. He rallied the other bondholders and launched a hostile takeover attempt. The boardroom became a vicious war zone. Lawsuits were flying, public insults were traded in the financial press, and the actual day-to-day business of making comic books ground to an absolute halt. In December of 1996, the company was officially forced to file for Chapter 11 bankruptcy. It was a humiliating defeat for a cultural icon. Icahn moved in for the kill. He petitioned the bankruptcy court to throw Ronald Perelman out of the company entirely and install himself as the chairman of the board. He wanted to seize control of the intellectual property, strip the company down to its bare studs, and sell the characters to the highest bidder to recoup his bond investments. If Carl Icahn had succeeded, the cinematic universe we know today would never have existed. The characters would have been auctioned off piecemeal to rival studios and media conglomerates. But while the two Wall Street titans were locked in a billion-dollar cage match over the debt, they completely ignored the single most important variable in the room. They ignored the toy makers. Ike Perlmutter and Avi Arad were the executives running Toy Biz. They were not Wall Street financiers. They were operators. They understood the physical product. They understood that the true value of the company wasn't in its junk bonds or its stock price. It was in the emotional connection the fans had with the characters. Because Toy Biz held the exclusive, perpetual, and royalty-free license to make the action figures, they held immense leverage in the bankruptcy proceedings. If the comic company died, Toy Biz lost its core product. But if Icahn chopped up the characters and sold them off, the toy license would become a legal nightmare. Perlmutter and Arad executed a brilliant, stealthy counteroffensive. While Perelman and Icahn were fighting over the existing, toxic corporate structure, Toy Biz essentially offered to buy the entire comic book company out of bankruptcy. They presented a restructuring plan to the banks that actually made operational sense. They proposed merging the toy company and the comic company, but under the leadership of the toy executives, not the Wall Street raiders. The bankruptcy judge looked at the three options: Perelman's diluted stock plan, Icahn's hostile liquidation, and the Toy Biz operational merger. The judge ruled against the billionaires. In a shocking upset, Ronald Perelman lost his entire equity stake. Carl Icahn was forced to walk away. Toy Biz absorbed the bankrupt publisher. Ike Perlmutter and Avi Arad took control of the company. They immediately stopped the gimmicky foil covers, stabilized the massive debt, and shifted the entire focus of the company away from Wall Street financial engineering and toward Hollywood licensing. They began laying the groundwork for the modern film studios that would eventually define a generation of cinema. The 1996 corporate war is the ultimate parable of financial engineering versus intrinsic value. In the modern economy, we see this exact same war fought every day in private equity. A firm will buy a beloved retail chain, a restaurant brand, or a media company using massive amounts of leveraged debt. They will then squeeze the life out of the product to pay off the interest. They cut the quality, they lay off the creative staff, and they alienate the core customer. They treat the spreadsheet as reality and the product as an inconvenience. But Wall Street mathematics cannot save a broken product. You can engineer the balance sheet, you can manipulate the stock price, and you can issue endless amounts of junk bonds. But if you destroy the core value that made the company great in the first place, the market will eventually correct you. Ronald Perelman and Carl Icahn looked at the company and saw a financial vehicle. The toy makers looked at the company and saw the characters. In the end, the people who understood the product won the war. Rule of capital. A brilliant financial structure will always collapse if it is built on a rotting product. This closes case file 013.